IBM has been paying an uninterrupted dividend since 1916 and currently yields a 4.9%. That's pretty good. Where does it go from here? If you want to see my analysis on IBM and what it caused me to do in my portfolio moving forward, then stay tuned. Hey dividend investors, I'm excited about this video because I believe I finally understand IBM's strategy moving forward. They've been paying a dividend for 105 years and currently yield 4.9%. So it's very attractive. Investing is serious business. And as dividend investors, we need to do our due diligence around stocks that we're looking to invest in. Because what we want at the end of the day is we want passive income. That passive income then feeds into our lifestyle to give us personal freedom. And that's what we're about, is personal freedom. Before we get started in the analysis, if you like this analysis on IBM, if you could give it a thumbs up, I would appreciate it. It would help support the channel. And also, if you like videos like this, if you are a dividend investor and you like dividends like this, then consider subscribing to the channel and ringing the bell so that you'll be notified of future videos. At the end of the video, I'll tag a couple of other analysis videos that I've put together. And if you're interested in any of those, click on those and watch through those. And also at the end, I'll update you on my top 10 holdings in my portfolio so you can keep up with all that's gone on here in the last week regarding my portfolio. So with that, let's get right into it. IBM is an American multinational technology corporation headquartered in Armonk, New York, with operations in over 171 countries. The company began in 1911, founded in Endicott, New York, by trust businessman Charles Ranlett Flint, and it was known as the Computing, Tabulating, Recording Company, or CTR. In 1924, it was renamed to IBM, or International Business Machines. Its industry is the information technology services area or industry, and you can see on the screen now a list of their competition. Looks like we have Infosys, Wipro, Cognizant, EPAM, and Gartner are their major competitors. Out of those, IBM is the largest, both by market cap as well as enterprise value and employees. So it looks like IBM is the largest of those. Interestingly, though, Cognizant has more Wall Street analysts following it by far than IBM. So I found that to be interesting. Recently, IBM spun off part of its business and named it Kyndryl. That business was part of their Global Technology Services segment. We'll go through the segments here in a few minutes. There's a little piece as well that was associated with the cloud and cognitive software segment. Kyndryl has now spun off, and those shares are existing in the public market. Those holders of IBM at the time were given shares of Kyndryl. I sold a lot of those immediately, and I did hold on to a few and wish that I had not. These are the unaudited financial statements for Kyndryl, and these were actually before. There's not been anything reported yet for Kyndryl other than the pro formas that I know of. Maybe there is, and if there are, if there have been, please let me know in the comments below. But you can see the pro forma for the first 6 months of 2021 shows Kyndryl at a loss net income wise. So it is not looking good for Kyndryl in terms of paying a dividend. It's hard to pay a dividend when you're losing money. Moving on then, the segments that IBM has, they have the cloud and cognitive software segment. This includes all of the company's software products except their operating system software. This will be more. This will become more apparent in a chart later on. Secondly, they have the global business services segment. This is their consulting arm. It's where they look at business processes, application management, and they try to work with companies to apply all of these softwares to the company's processes. Their third segment is the global technology services segment. This is the one that most of Kyndryl comes from. It is the IT infrastructure and platform services. It includes the set of hybrid cloud solutions and services. It's about 1% of IBM's net income in 2020. Interestingly, in the cloud and cognitive software segment is 70%. So the software itself that IBM has is about 70% of their net income. The consulting piece, which is the global business services piece, is about 15%. So those two items together are 85% of the net income for IBM. Moving on to the fourth segment, it's systems. It comprises about 5% of the net income, and it's the infrastructure platforms. This is where that software is, the organizational software, operating system software that was mentioned earlier. So this is where that software resides. And then lastly, they have a financing arm. This is about 8% of their combined segment pre-tax income. So on this particular slide, you see all of the income 2020 versus 2019 from IBM's segments. The interesting thing that you see at the bottom, and I've circled it in red, is that their consolidated revenues have declined and their consolidated gross margin has declined, although it looks like they have increased their gross margin percentage just by a small bit. So this is not a good look for IBM that they're actually decreasing in sales. Competitive advantage looks like they really have two things that gives them a bit of a moat, and that is the consulting expertise that they have with infrastructure and specialized business knowledge. So companies, these big companies that rely on IBM's architecture as well as their hybrid cloud solution rely on this consulting expertise, and it provides value for their business. The second piece is the complex integrated IT infrastructure for critical business function data in some of these big regulated companies. I know utilities use them a lot, as well as banks. And so these big regulated companies have these integrated, complex IT infrastructures, and these companies are a bit slow to change. So we'll talk about that in just a moment. So to give you a bit of a picture of this competitive strategy, and this is why I think I now understand what IBM is planning from a strategy perspective, is that they want to create not a cloud, but what they're calling a hybrid cloud. This hybrid cloud takes their existing IBM infrastructure and it runs it through an acquisition that a software acquisition that they had called Red Hat, and it combines it with other software that is cloud-based, and they're marrying up all of this data. So they're creating for themselves what they're calling a hybrid cloud, where you can take information out of their existing systems, moving it into a cloud type of environment. So, and again, earlier we talked about the two areas of competitive advantage. One is this IBM consulting, and the other is the IBM infrastructure that you see below the Red Hat. And notice the cute arrows here to the moat with the castle in the middle. And what makes these significant is that there are huge switching costs for both the consulting and the infrastructure pieces of IBM, for someone to come in and have the business knowledge that IBM has in its consulting realm. they would have to really invest time and energy, and it would be very costly to do that. The same with the infrastructure. There would be a tremendous amount of expense related to switching all of this infrastructure out. So therefore, they have these switching costs that's keeping that sticky for them. Both of them make up IBM's moat, but it looks like IBM's moat is deteriorating. And one of the ways that we see this is Morningstar's analysis. And I've highlighted a section here that says, we think IBM's moat is deteriorating as the cloud transition chips away at IBM's competitive advantage associated with customer switching costs. So as the cloud becomes more ubiquitous, for instance, IBM is not going to have the ability to keep this hybrid cloud going. They've made a lot of acquisitions thus far in 2021. You can see on the screen here, just over $3 billion have been spent on acquisitions. They list the acquisitions, and they tell what they do, but they don't give you a sense for which ones were of what value. So I'm not really sure this is that meaningful unless you're really knowledgeable about this space. They also just announced a new acquisition called Invisi, which they also did not give the financial details associated with it, but it's going to be one of these softwares that they put in this hybrid cloud that's going to be focused on environmental performance management. So what they're trying to do is they're trying to take all of these softwares that address issues that companies have, and they're putting them in the cloud space, and then they're going into their complex infrastructure through Red Hat to pull the data associated with whatever those software packages need, which is what I believe their strategy is. They're going to be trying to create this hybrid cloud to keep companies invested in their infrastructure, as well as buying new software. And by the way, also buying Red Hat and paying for the consulting to get all of that calibrated as well. Several risks here. One is that the intensity of cloud competition is going to create some pressure on the strategy of this hybrid cloud. The thing that the IBM has going for it is that their main customer base are these large, slow to change customers. And so it's going to take a while for it to erode, but it does look like it is a long-term bleed out unless they can come up with some other way to make money, which they're working on. They're trying to develop other activities. They're working on a quantum computer. They're working on blockchain services. And so one of the risks is that all of the money that they're investing in these new endeavors won't be able to be monetized. So that's a risk for them. Capital allocation. Let's take a look at that. Dividend growth. Wow, look at that. That's pretty impressive. Over the last 5 years, they've grown their dividend by 5% per year. Over the last 20 years, it's 14% per year. But the latest was only 0.6%. The dividend yield at the time I pulled this information was 4.94%. I believe as of today, it closed at 4.87, but it's still in that 4.9% dividend yield range. And this is some information from Simply Safe Dividends that talks about their track record of paying uninterrupted dividends since 1916. They have, a single A credit rating, and all of that kind of supports the dividend for now, but they're going to eventually need to return to sustained revenue growth. So everybody is kind of seeing this lack of growth in IBM, and they believe it's because of their strategy is deteriorating, basically. So capital allocation continued. We have shares outstanding. They've actually bought back a lot of shares in the last 10 years. But if you look closely, you'll notice that in 2014 or 15, that slowed down dramatically. Actually, between 20 and 21, they've actually added a few million shares. So dividend policy. Looks like the information from IBM and Kyndryl is that the The combined dividend of both of those companies is expected to be no less than IBM's pre-spinoff dividend per share. Looks like, from my perspective, Kyndryl is not going to be giving a dividend, so IBM's going to have to step up and continue that dividend. Now, whether they continue that long term or not, I don't really know. I'm not really sure how they're going to be able to sustain the dividend. And that'll be apparent as we move on here. We're going to look at the total sales. You can see back in 2011, it was $107 billion. In the last 12 months have been $74.5 billion. So on going in the wrong trajectory there. Their earnings per share has declined as well significantly as of late. Their free cash flow is actually moving higher, but not much, just a tad bit. But at least it gives them the ability to sustain the dividend. When we look at the earnings payout ratio, it has gone from 22% back in 2011 to a whopping 64% in the next 12 months. It is currently at 75%. The free cash flow payout ratio actually looks pretty decent. So, this is not tomorrow that things are going to go crazy, but the writing's on the wall. It's a bit of a slow bleed. That's kind of the way I see it anyway. The financial metrics for dividend safety, Simply Safe Dividends rates them at a 65. And their S&P credit rating is an A-, which, both of those are pretty decent. Net debt to capital, they've got a pretty high debt rating at 0.67. And notice that their interest coverage has dropped dramatically. So over the last 12 months, they're at a 7.63, which is a little bit below the 8 that is preferred for most companies. So things are not looking so good on the financial front for IBM. In terms of valuation, Morningstar has them valued at $119. This would be a premium of 12%. And Seeking Alpha shows a price target for them of $130, $131 on average, with the high being about 176 and the low being 106. So current price is 133. The valuation is 119. It shows that they're actually trading at a premium of around 12%. The average analyst price target is 130. They're already trading in that range, so I'm not really sure that there's a tremendous upside in share price for IBM. So in summary, IBM's IT infrastructure is large and it is in large and slow to change companies. There's a significant business knowledge in the consulting group. They've paid uninterrupted dividends since 1916, and they have a nearly 5% dividend yield. On the flip side, they have declining financial metrics. Their sales are dropping. Their earnings are not as good as they were. Payout ratio is suffering. They are incurring more debt. The interest coverage ratio is getting weaker, and the moat appears to be decreasing, although it is still there. It appears to be decreasing. The strategy doesn't appear to be clearly articulated. I've heard several people say they're not really sure what IBM's plan is, and it took me a while to at least come up with something that I think makes sense of what they're saying. I may have missed it, and if I did, certainly give me comments in the notes below. It also appears that they are 12% overvalued. Can IBM reinvent itself? And will it keep its dividend? Those are the questions. My dividend growth portfolio focuses on companies who are growing their dividend quickly. I also at times buy companies or stock in that portfolio that I believe is deeply discounted. So like a deep value stock, something that's significantly undervalued. And I believed at that point that IBM fell in that category. So I bought some shares of IBM in my growth portfolio. I also have shares in the yield portfolio because, come on, 4.9% yield. That's not so shabby. So what did I decide to do? I decided to sell the IBM position in my growth portfolio and keep the shares that are in my yield portfolio. So I ended up selling 202.678 shares out of the growth portfolio, but I kept 85 shares that I have in the yield portfolio. I think it makes sense. I'm not expecting the dividend to grow significantly in IBM, nor am I expecting a significant increase in the price per share of IBM. So therefore, it didn't make sense anymore to hold it in my growth portfolio. However, at 4.9% dividend, I'm also not really expecting them to cut the dividend significantly either. So I'm going to keep it in my yield portfolio, no longer carry it in my growth portfolio. We'll obviously keep an eye on it, and if things if things change, then we'll do something differently. But as of now, that's what I have planned to do. So will IBM's strategy work? Well, I hope so. I hope for their sake that it works, and that these 85 shares that I have grow in value and they increase their dividend in the long run. But we'll just have to wait and see. Remember, though, I'm not an investing professional. Anything that I've said here is really just having you walk down the road with me as I manage my portfolio. As you know, each investor is different and each portfolio is different. So it's important for you to do your own due diligence. Also, I will point out that I do have a new microphone, and let me know in the comments below if the microphone is helpful. And also let me know what your thoughts are on IBM. Again, at the end of the video, I'm going to give you some links to other analyses that I've done, as well as show you my top 10 list to update you on what my portfolio looks like. So with that, I will see you on the next video.